our topic today is what's new with Social Security, 7 topics that you want to watch in 2024. So I really appreciate you joining. Again, we're going to keep this to about a half an hour, so we've got plenty of time. I'm going to be here until the top of the next hour, 1 o'clock Central Time. So that should give us somewhere around 25, 30 minutes for questions and answers. So I want to make sure that I can help be a resource for you if you've got anything somewhat specific. Obviously, if it's specific to your situation, we have to be a little bit careful about that, providing any specific advice. But we'll definitely have time for questions when we get before we wrap up today. As always, we got to go through our compliance disclosure, make sure that we keep our compliance folks happy, especially as they are probably watching or listening to this as I get the recording approved by compliance so I can share it with anybody that couldn't join us today. But just keep in mind that this is for educational and informational purposes only. If you have specific questions to your situation, be sure that you consult your tax advisor, your financial advisor. If you don't have one of those professionals on your team right now and you'd like to have a conversation with us on how we might be able to help you in those areas, please let us know. I'll share a little bit more about how you can do that again before we wrap up today. So let's move on to the fun stuff. So let's talk about here the 7 items that we're going to be talking about today. So Social Security every year they pay a cost of living adjustment. Now there has been a year or two here and there where there wasn't an increase, but that's because inflation in those particular years prior to that was pretty much zero. But for the last couple of years, as you probably have heard, that cost of living increase has been pretty sizable. And we're going to talk about how the cost of living adjustment is determined, put that into some context, and then see what it means for your Social Security benefits going forward. Another number that it's affected by the cost of living adjustment is the earnings test threshold. And we're going to talk about how much you can earn in 2024 without having your benefits withheld if you claim Social Security before you turn full retirement age. Then we're going to talk about taxes, both the Social Security payroll taxes and the income taxes that you may pay on your Social Security benefits. And then for those of you who are on Medicare or maybe on Medicare soon, we're going to go over the new Part B premiums for 2024. And we're going to see why it's not such a straightforward number anymore. And then we're going to cover some very important dates you want to be aware of in 2024 as well. Then I'm going to talk about some updates on the status of Social Security, the trust fund, and we're going to talk about some of the ideas that are floating around out there about reforming the system to make it solvent for the future. And then the last thing we're going to talk about is just a brief update on some of these Social Security claiming strategies that are either still available and some that are no longer available that I get questions about quite a bit. So let's get into the first one here. So we're going to start with the cost of living adjustment. So in October of every year, the Social Security Administration announces a bunch of numbers that are determined by the rate of inflation over the prior 12 months. The most eagerly awaited of those, of course, is going to be the cost of living adjustment, or the amount by which your Social Security check is going to be raised in the following year. Now, another number again is the earnings test threshold. And then finally, the maximum amount of earnings on which Social Security taxes can be assessed. So those are all affected by these numbers that we're going to talk about here. So the cost of living adjustment for 2024 is 3.2%. So this means if your current benefit is $800, you're getting an extra $2,600 a month. Now, the higher your benefit, of course, the higher your cost of living is in terms of real dollars. If your benefit is $4,000, which would happen if you happen to be a maximum earner and waited till age 70 to file, you actually could be getting a cost of living adjustment of $128 a month. Now, this latest 3.2% cost of living adjustment obviously pales quite a bit in comparison to the year before. Last year at 8.7, and even the year before that, I think it was 5.9. But since 1989, the cost of living adjustment has averaged about 2.6% per year. And the Social Security trustees project a 2.4% cost of living adjustment going forward. So they have to make some of these assumptions. So when you hear about where things are at with Social Security and the possibility of it going dry, these are all kind of based on some of the assumptions that are out there, and that's the one that the Social Security trustees use, is that 2.4% cost of living adjustment going forward. So the cost of living adjustment is based on the consumer price index for all urban wage earners. So the consumer price index measures the change in a basket of goods and services that a typical urban worker might buy. So it's going to cover things like food, transportation, housing, entertainment, healthcare, and pretty much everything people might spend money on. In any case, the cost of living adjustment is announced each year in October, and then it takes effect with Social Security checks you receive in January. Even if you haven't started Social Security yet, let's say you're delaying to age 70 or you're trying to delay your benefit for whatever reason might make sense for you to get a higher amount, your benefit will be raised by that cost of living adjustments or the COLA. So when you do claim your benefit, you can still be sure that it's going to reflect those prior year adjustments. Now, if you're interested in learning more about how the COLA was calculated, you can actually go to the website that you can see there on your screen, the ssa.gov/OACT/COLA/latest COLA at the HTML extension there. You can see that. You can actually go to that website to see how all these numbers come together to help to determine what the annual cost of living adjustment is going to be. Now, the earnings test, and so that's the first big number, of course. Now we want to talk about the earnings test. And this, again, this applies if you are working and receiving Social Security benefits younger than your full retirement age. So let's say you filed early, you filed at 62 or 63, you're limited in terms of how much you can earn before it potentially impacts your benefit. So the earnings test threshold is affected by the cost of living adjustment as well. And as you probably know, if you're under full retirement age and you work and receive Social Security benefits, part of your benefit may be withheld. So they're going to withhold $1 for every $2 that you earn over this threshold, which went up to $22,320 this year as compared to $21,240 last year. So if you earn less than $22,320, none of your benefits are going to be withheld. But I'd just like to comment that trying to earn less money is not exactly a formula for wealth building. So if you're under full retirement age and you have the opportunity and the ability to work, it is probably better to earn as much as you can and delay, if possible, the filing for your benefits. Now, the new threshold for the year that you turn your full retirement age is now $59,520, up from $56,520 last year. So the higher threshold comes into play if you were receiving Social Security last year and you turn your full retirement age in 2024. Now, in the months leading up to your full retirement age month, $1 in benefits will be withheld for every $3 you earn over that $59,520. Now, again, keep in mind, once you turn full retirement age, no benefits are going to be withheld no matter how much you earn. So you want to be aware of that. Now, while we're on the earnings test, I want to talk a little bit about the monthly earnings test. Now, this comes into play the first year that you apply for Social Security benefits. So let's say you're under full retirement age, you filed for Social Security this year, and you continue to work. If you earn more than $1,860 in any month, your benefit's going to be withheld for that particular month. Then next year, you'll be subject to the annual earnings test, that $22,320 adjusted for next year's cost of living increase, whatever that might be. Now, generally, our recommendation is to wait until you stop working to apply for Social Security so you don't have to deal with the earnings test. But obviously, we know that there's going to be exceptions for different people for different reasons. And actually, if you feel like you want to discuss those, we're happy to have those conversations with you based on your specific circumstances. All right, so having said all that about the cost of living adjustment and the earnings test, I want to take a little bit of time to talk about the payroll taxes related to Social Security. So the maximum earnings subject to Social Security tax went up to $168,600 from $160,200 last year. So this means that higher earners will pay Social Security taxes on more of their earnings. Now, again, remember that Social Security taxes represent a pretty good investment. There's arguments getting made about your thoughts on Social Security, but the fact is you get a form of inflation adjusted income that lasts for life. Whatever your feelings are about the Social Security system and how all it works, again, it is a guaranteed source of income that you can't outlive. Now, the more earnings you have, the more Social Security taxes you pay, the higher your benefit ultimately will be. Now, remember, as long as you're working and you're paying into Social Security, your benefit will continue to be adjusted. So if you improve your earnings record, your benefit may go up even if you've already started collecting benefits. So that's also something to keep in mind. And again, if you're interested in seeing how the Social Security Administration calculates the earnings cap, you can follow this link that's on your screen as well. So that's going to be more related to your Social Security taxes that you're paying if you're still working. All right, so now keep in mind the Social Security tax rate did not change. So as an employee, you're going to pay 6.2% in payroll taxes on your earnings. Your employer will pay the same amount. If you're self-employed, you will pay both parts, a total of 12.4%. Now, the Medicare tax also did not change. So the employee's portion of Medicare is 1.45% on all earnings, That's the other thing, though. So I'll just touch on that while we're here. The Medicare portion does not have an income cap. So it's on every dollar that you earn, whereas Social Security is limited, as we just saw a second ago. Self-employed people will pay both sides of Medicare as well. So a total of 2.9% for self-employed individuals. So here's a little bit of math. So if you earn a maximum of $168,600 in 2024, you will pay $10,453.20 in Social Security taxes. If you're self-employed, you'll pay both the employee and the employer share of that tax, so a total of $20,906.40. And of course, Medicare tax will be on top of that. So that takes care of the payroll taxes, or the taxes that'll be collected to fund Social Security and Medicare. Now I want to talk about the taxes on your actual benefits, which are going to be, of course, a little bit different. Ever since 1984, Social Security benefits have been subject to some level of taxation depending on your other income. And this table is going to show the taxation of Social Security benefits based on the various income levels. And an income, in this case, means what we call provisional income, which is going to include adjusted gross income plus 1/2 of the Social Security benefit, plus any tax exempt interest. So tax exempt bonds, tax exempt money markets, things like that, that actually gets added back in. So if your provisional income is under $32,000 for a married couple, no benefits are going to be subject to tax. If your provisional income is between $32,000 and $44,000, up to 50% of a married couple's benefits are subject to tax. And then if your provisional income is over $44,000, up to 85% of your benefits are subject to tax. Now, the thresholds for a single individual are $25,000 and $34,000. And in the case of a married filing separately and living with spouse, 85% of your Social Security is taxable regardless of income level. Now, one thing that I really want to note, and this is something that the people always income taxes on their Social Security benefits. So those thresholds, the 32,000, 44,000, so on, those have never been adjusted. The important thing to remember is that up to 85% of your Social Security benefits may be subject to tax depending on how much other income that you have. Now, here's the part that touches on tax planning just a little bit. So if you're on Social Security, you have IRAs or 401ks, things like that. So it's important to keep in mind that the law recently changed regarding required minimum distributions, or RMDs. So you may remember that it used to be you had to start taking minimum distributions from your IRA accounts starting at 70 and a half. Then a couple of years ago, the age was raised to 72, and then the most recent legislation raised it to 73 starting in 2024. So please let me know if you need some help with RMDs and how all that works. Please let us know. We'd be happy again to have that conversation. But the thing about RMDs is that you may have had your income and your tax situation all figured out. And then you have to start taking these required minimum distributions from your IRA. If you don't plan ahead, these RMDs can not only bump you up into a higher tax bracket, but in addition to having to pay taxes on these RMDs, they may actually cause you to pay more income tax on your Social Security benefits as well, because those distributions go into that provisional income number that I just talked about. So here's just a couple ideas as far as trying to help have some control over that, how to minimize the impact. And it's a good idea to plan for your Social Security taxes ahead of time. So those of you that may be still well in advance of your RMD age, you may want to start drawing down some of those assets so that the RMDs don't force you into a higher tax bracket for Social Security. Now, the operative word there is might. Actually, beating the Social Security tax might not be worth it pending other tax considerations. So this is, again, one of those areas where you really want to talk to a qualified tax professional. Now, you also want to think about Roth conversions, converting IRA dollars to Roth IRA dollars, which generates tax-free income. Again, Roth IRA distributions, a key tax planning point. It's tax-free, but it does not get included in that provisional income like municipal bonds or municipal or tax-free money markets and things like that. So that's, again, a key tax planning aspect. So again, talk to your tax specialist before you start looking at Roth conversions. Now, of course, the other way to pay less on Social Security tax is to simply delay your Social Security benefit. This reduces the number of years that you're going to be subject to income tax on Social Security benefits. And this is not the main reason to delay benefits. Delaying Social Security benefits is mostly advantageous because of that higher benefit you get by delaying, but it also helps with your tax situation as well. All right, so let's talk about Medicare premiums. So 2024 Medicare premiums. So the base Part B premium in 2024 is $174.70. And this is up from $164.90 last year. So that base premium is higher. Also keep in mind that some people may pay even more due to what's called the income-related monthly adjustment amount. Let me spit that out, or IRMA, which I'm going to talk about in just a second. Now, if you're on Social Security and you have your Medicare Part B premium deducted from your Social Security benefit, there's what's called a hold harmless provision that keeps your check from going down if the Social Security cost of living adjustment doesn't cover the rise in that Part B premium. Now, this year, the Social Security COLA was 3.2%, as we talked about just a while ago. So while the Part B premium did go up by 5.9%, in most cases, that dollar amount of the cost of living adjustment was more than enough to cover that increase in premiums. So the hold harmless provision doesn't apply. Now, the issue that will be affecting more people is the income-related monthly adjustment amount that I touched on a second ago, or what's called IRMA. This applies to your Medicare premiums. Now, the IRMA is an extra premium that you must pay if your modified adjusted gross income exceeds certain thresholds. So in 2024, the first threshold is $103,000 if you're a single filer or a married filing separately, up from $97,000 last year. For married couples, that first threshold is going to be at $206,000, up from $194,000. Now, MAGI, modified adjusted gross income, for this purpose is adjusted gross income, again, plus tax-exempt interest. Now, your premium each year is going to be based on your tax return that you filed 2 years prior. So if you are on Medicare, your 2024 premium is based on the income that you reported in 2022. But if your income has changed due to a specific life-changing event, such as retirement, you can actually appeal. In other words, if you reported high income in 22 and you have since retired, you can appeal that higher premium. Now, again, one thing I really want you to note is that a one-time capital gain is not grounds for appeal. In other words, if your 2022 tax return shows high end because you sold an asset, had a situation with a client not too long ago where they sold a house, a rent house, and that capital gain put them above that IRMA threshold. Nothing you can do about that. There's not anything you can do. You just got to bite the bullet and pay those higher premiums. But again, your 2024 premium is based on your 2022 tax return. And then if your income has gone back down in 2023, then that means your 2025 premium will be lower. So again, that can be really confusing, and really is important from a planning perspective that you time those issues out. All right, so this table shows your Part B and your Part D premiums for the different income levels. So if you're single and your income was under 103,000, or if you're married and your income was under 206,000, you'll pay the regular Part B premium of $174.70. There will be no income-related adjustment. If your income falls into these other tiers, you will pay an income-related adjustment on top of that base premium. So for example, if you're in that second tier, you'll pay an extra $68.70 for Part B and $12.90 for Part D on top of the regular premiums. Now, keep in mind that these are per person. So if you're a married couple, you can double these amounts. And again, planning wise, you got to make sure you include that in your cash flow projections. Now, your tax return from 2 years ago is used to determine these income related adjustments. I just touched on that. So, again, using our example, your 2024 adjustment would be based on the income that you reported on your 2022 tax return. And also keep in mind that the premiums shown here do not include premiums for any Medicare supplements or Medicare Advantage plans if you happen to be on one of those plans. This is just for the basic Medicare. Now, whether you're on Medicare or you're getting ready to start, I want to touch on some of these important dates here in 2024 that you want to be aware of. So the Medicare Advantage disenrollment period is from January 1 to March 31. So during this time, you can get out of Medicare Advantage, a Medicare Advantage plan, and you can go back to original Medicare. But you do want to make sure that you can get supplemental coverage. If you're going back to original Medicare, you'll want to get those gaps covered with a Medigap policy. But unless you're applying during your Medicap, your what's called your Medicap open enrollment period, which is generally that first 6 months after enrolling in Part B, they don't have to take you. So if you have health issues and you drop your Medicare Advantage plan, you may not be able to get a Medigap policy. So you want to be sure that you get that lined up first. And if you happen to be thinking about trying to drop Medicare Advantage. Now, January 1 through March 31 is also the Medicare the general enrollment period. So this is for people who never signed up for Medicare when they turned 65, or maybe they left their employer plan. So if you do sign up for Medicare during this time, your coverage is going to be effective starting July 1. Now, the annual open enrollment period for people on Medicare is October 15th to December 7th. So in September, you're going to receive information from your current plan about their offerings for the following year. And you want to pay attention to this. So your premiums might be going up, or your coverage might change, or there might be new plans in your area. So if you currently have a Medicare Advantage plan, you'll want to see how it will change for the following year. If you have original Medicare, you'll want to see how your drug plan will change for the next year, those types of things. And then you'll want to look at other plans offered in your area to see if there's anything that might be better. And if so, you want to make sure you contact that new plan by December 7th. If you do nothing, you will be re-enrolled in your current plan for another year. And although you will have another chance to switch Medicare Advantage plans during the disenrollment period we just talked about, it is much more efficient to make your choice during this annual open enrollment period and stay in your new plan for that full calendar year, if at all possible. All right, so let's talk about the future of Social Security. What are we headed for here? Let's talk about some of these things, because there's a lot of stuff that gets in the news. It becomes very politicized. So I want to make sure we kind of talk through what's actually happening. So you got to understand, first of all, that Social Security was designed as a pay-as-you-go system. Payroll taxes from current workers go into that trust fund and immediately paid out to current retirees. Now, because baby boomers have been in their peak earning years, the trust fund has accumulated more than needed for current benefits. So right now, the trust fund holds about $2.8 trillion, which is invested in special issue treasury securities. But as baby boomers continue retiring, these trust fund assets will gradually be drawn down. So over the next 75 years, we're going to see costs will begin to exceed income. There are enough reserves that the system will be able to pay 100% of promised benefits until 2034 as the current projection. After that, if nothing is done to reform the system, income will be sufficient to cover just about 80% of promised benefits. So when I get that question, I say, well, if you're really concerned, if you're doing some projections, you're doing some retirement planning, maybe you retire in the next 10 to 15 years, simply say, okay, I'm just going to plan on about 80% of what my benefit statement, my Social Security benefit statement is showing me. That's kind of the worst case scenario. Now, we'll talk about some of the potential solutions here that could be coming down the way. So although again, talked about the Social Security system is not in imminent danger. Most people agree that the earlier the reforms are instituted, the less painful they're going to be on everyone. So it really just becomes a math problem that involves an increase in revenues, a cut in benefits, or some combination of these two. So here's just a few of the ideas that are being proposed. So first thing is to potentially increase the maximum earnings subject to Social Security tax. So we talked about this earlier. It's currently $168,600 in earnings that is subject to that 6.2% tax paid by you and your employer. So, of course, one of the ways to shore up the system is to raise that earnings cap or maybe even eliminate it altogether, kind of like what the situation is with Medicare. Now, another reform proposal calls for raising the full retirement age. Currently, full retirement age is 66 for people born between 1943 and 1954, and it's 67 for people who were born in 1960 or later. Now, of course, an argument in favor of raising that retirement age is that people are living longer. An argument against that, of course, is people whose occupations involve physical labor really can't work until age 70 in many cases. So you got a lot of factors at play here that can potentially make that a challenge. Still, another reform proposal would change the benefit formula so that future increases would happen at a slower pace. Now, this would affect the benefits of future retirees. And then there's also some talking about changing the formula for cost of living adjustments. Now, this could give retirees smaller benefit increases going forward, although the changes there are expected to be minimal. Now, of course, given that there are lots of ways Social Security system can be reformed, is Congress likely to address the issue this year? Probably not. Other issues are taking priority, and because of that $2.8 trillion trust fund, benefits are not in immediate danger. Nothing's going to happen tomorrow. The last time the Congress made major changes to the Social Security system was 1983. The trust fund was within just a few months of running out of money at that point. So theoretically, Congress has until 2034 before they actually have to worry about that happening. All right, so to finish up here, I want to talk a little bit about Social Security claiming strategies, even though these may not affect all of you, especially those of you who are already started taking your Social Security benefit. But I think it's important because these are some of the questions that I get quite a bit. Some of you in the audience, as you're on here, you may have heard about a strategy called file and suspend. And just to refresh, that's the one where a high earning spouse files for his or her benefits, immediately suspends them, and then because he or she has opened their filing, their record, the lower earning spouse can actually start claiming spousal benefits at that point. Now, the Budget Act passed in November of 2015 disallowed certain spousal claiming strategies. File and suspend was one of those that was done away with. The last day to file and suspend was April 29th of 2016. So unless you placed your suspension before April 29th, 2016, your spouse will not be able to claim a spousal benefit in this way. For those of you who did suspend before the deadline, and honestly, that's only the reason I'm bringing it up, it becomes mostly a question of making sure that your spouse takes their spousal benefit at the optimal time if they haven't already done that. So other than that, it's basically a question of sitting back and waiting. So your benefit will automatically resume at age 70. Now, the other strategy, the claim now, claim more later, was good while it lasted. It used to be possible that you could claim a spousal benefit while your own benefit was building delayed credits to that age 70, but Congress abolished this strategy in November 2015. But people born before 1954 were grandfathered. So all of those people have now turned 70 and are taking their own benefit. So there's no one left to implement this particular strategy. So again, but it is a question. The reason I bring it up is because I get a lot of questions about it. Let's see, anything I want to touch on there? I think we're good there. Now, although some of the spousal loopholes have closed, it is still possible for lower earning spouses to receive 50% of the higher earning spouse's PIA, their primary insured amount, if that lower earning spouse claims their own benefit, if the lower earning spouse's own benefit is lower. So please note that if you're a lower earning spouse is claiming the spousal benefit before her full retirement age, that spousal benefit will be less than 50%. Also, the other spouse must be taking his or her own benefit. And if the higher earning spouse's benefit includes delayed credits because he or she claimed after full retirement age, the spousal benefit will not include those delayed credits. So that's, again, another important point to remember. Now, we'd be glad, again, to run a spousal planning analysis for you to show you when would be the best time for each of you to claim your respective benefit. And again, I'll show you how to do that here in just a bit. All right, so for the most part, that takes care of what's new with Social Security. Now let's talk about some reasons that you may want to think about a Social Security checkup, whether it's with your own advisor, with us, and we'd be happy to help. In working with clients on Social Security, we found that sometimes people miss out on benefits simply because they didn't know how to claim them, or they didn't know they were eligible for those. I'll walk you through just a few of those examples. So here's a situation that's not terribly uncommon. A married person who never added on her spousal benefit after her husband filed. For example, in doing Social Security checkups, we would look to see if the lower earning spouse's benefit is significantly lower than 50% of that higher earning spouse's benefit, because this could suggest that the lower earning spouse filed first and then claimed their own smaller benefit. And then sometime later, her husband filed for his benefit. This would entitle the spouse, the wife, which would be added on to her own smaller benefit. So they don't always get, let's say, husband's benefit's $3,000, wife's benefit is 1,000, but they never filed for that spousal add-on to get up to that 1,500. That's kind of what we're talking about here. So you don't make sure that you're getting every dollar that you're eligible for. Another one is that a divorced person who didn't know she could claim a spousal benefit off her ex-spouse. Now, not everyone can do this because your own benefit must be less than half of your ex's. If you've been working, your own benefit probably exceeds your divorced spouse benefit, but if it's always good to check. Our Social Security checkups can always help divorced people find out if they're getting what they're supposed to be getting. Now, here's another one: a divorced person whose ex-spouse has died. Sometimes ex-spouses don't always keep track of each other. But if a person was married for over 10 years to an ex-spouse that has passed away, she may be able to get a survivor benefit based on that ex-spouse's earnings record, which is higher than her own benefit. And obviously, these are not limited to women. The Social Security system is gender neutral. So divorced men can also claim benefits based on an ex-spouse's work record as well. So again, try to get through this relatively quickly to make sure we have plenty of time for Q&A. As a quick heads up, our next webinar that I'm going to be doing is May 9th. Also, again, we're going to be doing that at 12 p.m. Central Time. We try to get these recorded, and we'll share those out for those that aren't able to make it either during the day or